Hi, Warriors. Special treat today. I'm here with Bob Elliot at Bob E Unlimited. Bob, talked to you yesterday, so I have some things that I'd like to stress that we talked about yesterday, and also some new things I saw from your stream. But a lot of people don't know, unless they really read your uh, X description of you, that you spent time with Ray Dalio at Bridgewater and I believe you were the CIO there.
Yeah, I was on the investment committee there at Bridgewater, and ran Ray Dalio's investment research team for a decade, and
Wow.
was part of the small handful of investors that helped take Bridgewater from being the challenger to the incumbent. It was quite a ride for almost 15 years.
Wow, that's a in this industry that we're in, anything over 6 months is long term. Anyway, I mean, for you to be able to, be there for 10, 15 years, um, what would you say are the most valuable things you learned while being there, either from Ray or the team or just being part of Bridgewater?
Yeah, I think from an investing standpoint, it was probably the best thing that the most important thing I learned was thinking systematically about your investing strategy. And I think um, there's sort of in the world of macro in particular, there's a lot of legend, let's say, of traders that discretionarily shoot from the hip and make big bets and get and make big money as a function of that. But we don't tell the tales of all the people who have made bad discretionary bets over time. And I think
Would
over
you like
time.
to see my P&Ls?
I
I will
love
publish
it.
them on X, and people could go,
I love it. I
"Oh,
love
I knew that guy was a charlatan." Uh,
it. No, and I think part of the thing about systematic investing is if you have an edge, which I think people who really work hard at this can develop edge in the markets, then what you want to do if you have edge is you want to bet that edge as much as you possibly can and as consistently as you possibly can, right? You want your swing to be the best swing you've got. And part of the benefit of systemization is it allows you to go do that more often, meaning across markets, and also more consistently because I mean, you've been in this business long
so
enough,
it's
like,
automated when you talk.
right,
Okay, instead of because we wake up sometimes. Yeah, I have migraines, and I am a
right,
discretionary trader,
right,
and I trade better when I feel better. But if you
right.
have but if you have a system, something mechanical that automatically executes your ideas, you don't have to feel it be in your peak performing state.
That's right. That's right. And I mean, you certainly know probably as well as anyone that part of trading markets is a head game. It's not
Oh,
just it's
yeah.
not just understanding the markets well, reading the charts well, reading the data well. It's about having the discipline and the head game to be able to execute on it as effectively as possible. And in a lot of ways, systemization it's just a way to do that more effectively than trying to keep it in your head, all in your head. And so and look, Bridgewater, huge hedge fund, thousands of strategies, ingesting millions of data points.
Yeah.
The everyday investor is not going to be able to build a systematic approach like that. But there's lots of things you can do incrementally along the path of systemization to help improve your ability to trade and execute as effectively as possible. So, don't think that you have to build some grand thing to be able to get edge and help with your discipline through trying to write down your decision rules, go back to them, you know
Code
um
them and code them.
code them. Exactly, that's right. And you don't even need, I mean, you don't need to build a beautiful Python based system to do that. You can, you know honestly, 9 times out of 10, you can build it in Excel or something like that, and it's good enough. It's
Yeah.
not like it's got to be a grandiose thing to get, an 80/20 benefit from writing your rules down and making sure you're following them.
Yeah. I work with a guy, Michael. Venezia, who covers such a large universe of stocks and then brings up things he's never talked about. And I go, I have a hard time focusing on more than two or three positions at a time.
Yeah.
And I may be um, compelled to do something somewhere else. And so my head is turned, and what I was looking at a couple of days before happens without me because my focus shifts to another instrument. So I think that's really a pearl. When you talk about edge versus perfection, you know, I say don't expect perfection at the crap table, right?
Oh,
Bob,
that's for sure.
so what's your edge?
Well, I think my edge when it comes to trading markets is in many ways it's about understanding the macroeconomic data in the context of market pricing and identifying opportunities where that macroeconomic data is inconsistent with what's going on with the market pricing, and taking advantage of those opportunities. And so I know that sounds a little obvious in nature,
Yeah,
but I think in a lot of ways, particularly in the macro environment, there's such a draw to narrative and such a draw to um, confirmation bias in looking at information that the discipline essentially to have objective views on what's going on with macroeconomic information, and using that understanding to look out for the places in the world where the markets have become more irrational, have become irrational in one direction or another relative to the data, is creates real market opportunity, real investment opportunities, as long as you sort of stick to the plan, and that's the
well,
basic. That's the thing.
you know,
Um,
I know you covered China, and just a couple of tidbits. In the last couple of days, I've read that um, the U.S. has replaced China as the largest trading partner with Mexico,
yeah,
which is kind of understandable, right? I mean, same
yeah.
continent and reshoring, but it's also happened with Germany. That's more recent and a little bit surprising to me.
Yeah, well, I
Is that?
think
Go ahead.
Yeah, I mean, I think it's been interesting to see the significant reduction in Chinese market share, particularly in the advanced economies. Market export market share in the U.S. for China was as high as something like 25%, if I'm remembering correctly, and is down to like 15%. I mean, that's a pretty remarkable drop.
Yeah.
And is a function. Part of it is a little bit fake, I'd say, in the sense
Sure.
of they're routing some goods through Mexico, and through Mexico's subsidiaries, but that's only a few percent of the overall picture. Which is, look, China's not very competitive right now. That's just all there is to it. They're not incrementally competitive, is maybe the best way to think about it. Whereas, economies that have less transportation costs and frankly better productivity adjusted wages like Mexico, they're just winning. Like I think that's an important thing to recognize. Mexico is just winning because they are, from a fundamentals perspective, from a productivity adjusted wage perspective, they are just cheaper and more efficient than China. That's why they're winning.
Okay. That's a that's really a paradigm shift.
It
That's
is. It
probably
is.
it's taken what, about 10 years for that to develop, right?
Well, yeah, I mean, part of the story is that China went from a situation where they had, they're bringing on tons of incremental marginal labor right from the farm to the factory. They brought 700 million people from farm to factory. And as that flow is happening, it's super beneficial, but that's it behind us. And so now you have, more and more expensive workforce in China, and frankly, they haven't gone through the efficiency gains, that have really been sort of the cornerstone of things like Mexican or Canadian manufacturing. And in addition, the exchange rate is not particularly competitive relative to either CAD or the Mexican peso. And so you put that
And
all together, it's not a very good outcome, not a very good look for China. Of course, they're moving
yeah,
up the value chain, they're producing more
yeah,
goods. There's things like whatever BYD or things like that that are taking on corners of the market. So it's not like it's a black and white thing, but the big picture of China as being the export out competitor in the rest of the world. It's just that was a story over the last 25 years, not a story for the next.
okay. So I know that we talked about the yuan, and I want to get to that. It sounds like they're not competitive. They need a weaker yuan to
That's right. I mean, just think about where the Japanese yen is. Like, if China's moving up the value chain, which they are, just think about where the Japanese yen is today versus where the Chinese yuan is on a like on a PPP basis or something like that, like on a productivity adjusted basis. The yen is undervalued by 50%, and the yuan is slightly overvalued. I mean, but just think that's a direct competitive environment that China, particularly as they attempt to move up the value chain, they're just in a bad state, the bad position. They need a cheaper currency if they're going to be more competitive. And because of the concerns by the Chinese administration of accepting exchange rate weakness, they're
yeah.
basically not letting the needed adjustment happen, the significant needed adjustment happen to become more competitive.
All right. So I want to talk about Chinese equities because China, the state, the government, has been coming in buying stocks, and Xi is promising more of it. And you talk about interventions, you talk about it in currency markets. Here's an intervention in equity markets. So do you view this as, and you say fade interventions.
Paid
So,
interventions. That's right.
so I'm assuming with uh, China intervening in equities that you would say this is a great chance to get out if you were long and took some heavy losses. And if you're a speculator, you'd be looking to get short China, that the lows are not in, like a lot of people believe. Is
Yeah,
that correct?
I think, look, central banks often intervene in prices, either exchange rates or stock markets. And when they intervene in the market price, but don't change the underlying fundamental policy,
Yeah.
they're doing is just providing exit liquidity for private sector pressures, which are moving in the opposite direction. And this chart, I really like this chart because if you just look, if you were to overlay a set of policy measures over the course of the last 9 months, what you'd see is each one of these pops that
Yeah.
you see through this chart, each
Yeah.
one had a policy story narrative that was
Here.
like, this is the thing that's going to create the turn. But
Right.
like, where's the turn? Like,
Yeah.
where is the turn? The turn isn't there. And the reason why that is because what they're doing is they're trying to intervene in the stock market rather than do what's necessary from a fundamental perspective, which is, look, China is experiencing like
Deflation. Yep.
a deflationary, not really quite deleveraging, but just kind of a deflationary, um, you know, sucking,
All
just
right. No,
deflationary mediocrity.
no consumer
Like,
demand for things,
right,
which
just
was what they wanted to shift to being more of a domestically supported economy than an export driven economy. That,
that's right. And so they haven't, but the reason why they haven't had that shift is not because it's an impossibility. It's very easy to stimulate domestic demand. Heck, we certainly have seen it in the US. We know
yeah.
how to, there's a
Maybe
path
they're
to
going to do
stimulate.
that. Maybe the
And
helicopters come out in China.
maybe the helicopters come out in China, but until that monetary policy changes,
Okay.
which would change the fundamental conditions, simply intervening in the asset market isn't going to be enough. They have to change the underlying fundamental monetary policy. And they just, for whatever reason, and the politics of China are, above my pay grade, they're not providing the level of monetary stimulation necessary to create an economic acceleration or an improvement in their markets.
Okay. And they had been spending a lot of money intervening to cap the weakness that we've seen, here. and here. And I
Yep.
think they went through plenty of reserves. And I know that you believe that the highs or the lows for the yuan are not in the way it's paired. It looks like the yuan's going higher, but this means lower. Um, what would they have to do, uh, the PBOC, to generate the kind of monetary policy that you think they need to make the adjustments rather than being central planners and intervening by buying stocks?
Yeah, well, I think the basic question is if they want to stimulate the economy, then they need to meaningfully lower interest rates,
Okay.
expand fiscal policy, and expand liquidity much more than they are doing right now. The problem is all of those steps are basically yuan negative, right?
Right.
And
Yeah.
so I think that's the core challenge is that they are prioritizing yuan stability at the expense of having asset price and domestic strength. And so, like in some
Why?
ways, well, why? The internal politics of China are
Opaque.
unique, I'd say, and I think important to recognize that um, when you're thinking from a macro perspective, when you think about a different countries policymakers, they're motivated by different things. So I think there's a lot of people who look at those pops in the equity
Yeah.
market and are
Yeah.
like they're thinking about it like a Western intervention, like Ben Bernanke in March of
Right.
2009 or something. But why does it have to be that way? A totally different and plausible policy sort of set of thinking is what Xi is trying to do is basically undermine the economic class so that he doesn't receive any threat from economic titans, right? Like
Okay.
if
Jack
that's what
Ma.
he's trying to do, then
Yeah.
this is a wildly successful policy, which is the exchange rate
Okay.
stable, stocks are going down, economic growth is fine, right? Fine for the everyday worker, right? They're
Yeah.
employed, they're working, they're getting an income. It's fine, but he's not creating an economic class that could threaten his political class. Right. As a simple example, if that's what the goal set was, this is actually the optimal strategy. And then kind of pretending like, oh, he's like, well, I'm really going to do something about these stocks. I'm really going to do something about these stocks. But really, all he's doing is consistently disappointing on that element and undermining it. Now, I don't have any particular understanding of the political dynamics or certainly any
Oh,
particular
yeah.
understanding of what she's doing. But what I do know is that the set of levers that they're pulling from a macroeconomic perspective is inconsistent with
Got it.
typical Western prioritization of responding to these sorts of conditions. And so then you must ask yourself the question, maybe their priorities are different than the priorities in the West.
Yeah. And, the average Chinese citizen, their two main investment avenues have been real estate and equities. And we know what happened to real estate. So it's caved, and now what's happened to the FXI over the course of the last few years? How could there be confidence for people to spend money on iPhones and Apple's having trouble selling over there? Um, uh,
Well, I
you
think I
know,
think the thing to wrestle with is who is getting burned by the weak stock market
yeah,
um and the weak housing market. It's not clear from again, if you put yourself in thinking through the values and the priorities that the Xi administration is thinking about, it's not clear that having people lose money on their second and third
yeah,
apartment homes, is
yeah,
necessarily
a
a
bad
bad
thing.
thing from a political power perspective. And that's where I just you have to get out of the Western idea. like erase it from your mind, under put yourself in the shoes of those policymakers and what their priorities are. And I think, for them, the biggest risk is not that you have, rich people essentially losing money on homes. That's fine. Rich people can lose money on homes, no big deal. The biggest risk that they have really is that there's an uncontrollable currency crisis. That's what they're really concerned about. And, it's not these are folks who lived through the Asian financial crisis.
Right.
They're very adept in understanding that dynamic, and and see that that is one of the biggest risks that they could take. Why did they accumulate $4 trillion of reserves? For exactly that reason, which is that they're incredibly concerned about that dynamic, and so they're prioritizing the currency stability. And when I say currency stability, it doesn't mean it won't sell off. I'm just saying, like, they're not going to have,
They don't want a
the
crash of the yuan.
right, the yuan is overvalued by 50% relative to the Japanese yen. I mean,
Yeah.
look, Japanese yen went down 50%, and who cared? I mean, really, like in Japan, like who cares? If anything, it's
That's
considered a good thing, right? But they're particularly concerned about the self-reinforcing aspect of the currency decline because of what happened in the Asian financial crisis, and then what happened early in Xi's power, which was what happened in 15 and 16 when they had a bit of an uncontrolled
I
currency move. And
remember.
so they're
Yeah.
very, very concerned about that point, and think that that matters a lot more than the common man and their real estate holding, or not
Well,
the common man, the rich man and their real estate holdings.
well, it's not an easy journey to leave China and come to the Mexican border. And the numbers of Chinese showing up at the border has gone up 5-10-fold in the last
Yeah,
few
that's interesting.
years.
I didn't know that.
Yeah, the huge increase. National security people are saying, well, they're not vetted. But when they're interviewed, they're leaving not just because of political repression, but because they can't make a living. They're having
Yeah.
a hard time making a living. So that's increased. And, as long as we're here with this political hot potato that people are politicizing, when we talked yesterday, you gave me a very interesting perspective on immigration that most people think of it as a national security issue, which it is because they're not vetting them. And most people think, oh, you know what? We're paying for all these people for their medical care and they're receiving income and assistance when they come here. And no one thinks about the downside of what could happen if we get draconian about immigration. So you want to tell us, depending upon who's in office, and it seems like it's becoming almost both parties now. Even the Democrats have caved to having more control of our border.
Yeah, well, I think it's an interesting from a macroeconomic perspective, and I'll leave the national security aspects,
Yeah,
or well, let's say the more values or moral base aspects aside, and really as a macroeconomist, really looking at what are the macroeconomic implications of that set of conditions. Um, the increase in immigration has had a significant impact in loosening the labor market conditions of particularly lower income cohorts. And that has been an important aspect of bringing down wages and bringing down wages in those groups and bringing down prices overall, nominal spending overall. And so, you have a set of conditions here where you have two policymakers that are certainly, I think, pursuing meaningfully different approaches on this question, which is, one which is pursuing basically a closed border system, and possibly deportation of currently unauthorized workers, and another that I think on the margin is tightening up, as you
yeah.
know, but isn't necessarily nearly as not anywhere close to as tight in terms of border controls. And so I think that's a real interesting, that's probably that, and maybe the Chinese tariffs are probably some of the prospective Chinese tariffs are probably some of the most interesting policy divergences between the two
Okay.
parties. And I think we're going to start to see some implications of those policy divergences probably start to affect markets. Now I think it's interesting. It's certainly notable that the weakness in China, while primarily domestically driven, but the weakness, particularly in external demand for Chinese assets, foreign demand for Chinese assets, has coincided with conversations about how from Trump about, his 60% tariff and things like that. That's certainly something that, if the odds become clearer in one direction or the other, that's probably going to start to affect markets pretty quickly.
Okay, and you're saying the main effect is because we don't have a growing labor force since COVID. People have been, uh, you know,
People are retiring.
unable to unable to find workers and fairly unwilling to let them go. Although some tech companies have made cuts. So when it comes to inflation, the wage price spiral is a real important part of it. And you say that if we start mass deportation, who's going to take the jobs? We're going to have
That's right. I mean,
more
it's
of a
just, you
yeah,
just think about it as, just like there's supply and demand in any market. Labor is just labor prices, which is really wages, right? Wage growth and wages are essentially the clearing price for labor. And so if you remove a supply side, part of the reason why we've been able to bring inflation down is because we've actually had a big increase in labor force participation in the last couple of years. That's essentially supply side, right?
right.
Um, and without it, unemployment rate would be moving into the low threes, even the high twos, without that labor force participation level being at all-time highs. And so if we remove a significant chunk of labor, that could easily create insufficient labor supply for certain sectors of the economy, particularly lower income cohorts, and companies will have to bid more to get the incremental worker. That's just how it's no different than any other market and supply and demand.
Okay. I want to wrap it with something I read. Gold has been like a beach ball lately. That every time they try and press it, we get a rally. I tried to short it today. I'm still short. I'm down $3, thinking that there could be one more break under 2000. But you talk about that it's mainly retail selling in the gold market in your stream, which, I was taught you fade retail. Do you get those figures from COT?
Oh,
Uh,
though, yeah, that figure, retail these days in the gold market is basically all in the ETF space because
okay.
it's just so efficient
GLD.
to, yeah, GLD, IAU, there's a
Okay.
handful of others, but it's
Yeah.
just because it's just so, if you're going to trade gold and invest in gold as a retail person, I mean, as a simple example, in my strategic portfolio, I just hold GLD or IAU. And so the flows that you see in those markets, in those ETFs, basically represent retail flow,
Okay.
and advisor directed retail flow. And it's been interesting that over the course of the last 18 months, though, despite gold holding up pretty well, doing pretty well and pushing to new highs, um, retail investment has been very negative. They've been, retail investors have been selling gold over that same time frame. So, it highlights that even a move to not selling anymore could be a meaningful support to the gold price on a forward-looking basis.
Okay. And you want to tell people a little bit about your ETF that you have, Bob, and maybe what the performance has been over the last 12 months, and was it a difficult process to get your own ETF and
Uh,
assemble? Was it
yeah,
tough?
yeah. We're my day job is running a company called Unlimited, where we use technology to replicate how hedge fund managers are positioned, and then package that into products that are available at lower cost for all investors, including
Okay.
as you know, ETF structure. And I think it's been an interesting period of time. Particularly, 2023, I think was particularly interesting because asset markets and YOLO stocks did very well, but professional asset managers were quite conservative. And so if you looked at how hedge funds performed over the course of 2023, like on a AUM weighted basis, they returned something like mid-ish single digits,
Okay.
which is not sounds not particularly compelling relative to stocks over the same time frame getting 20+%. I think the thing that when you think about hedge funds in general, the thing that they're very good at is being quite conservative during challenging market environments that are volatile. So if you just open the aperture a little bit farther and you look at since January 1st, 2022, which is basically the tightening cycle from the Fed, that's when it started. Hedge funds are up in the around 10%, let's say, give or take, over that time frame. And so are stocks up about the same amount, but hedge funds experience very modest drawdowns, and stocks went down 25 or 30%, depending on what you're looking at. And bonds, to
Right.
be clear, are still in
Yes.
drawdown, and long bonds at risk match to stocks are down 40% over that time frame, or at a drawdown of 40%. And so probably for many retail investors, it's not that interesting. But for long-term strategic investors who are thinking about how do you build sort of the boring strategic portfolio that just kind of moves up and to the right, the promise of hedge funds is a pretty good, from a risk return perspective, and a return stream that you can add to your portfolio. That's the basic idea, that over time has stock-like returns. Hedge funds have had stock-like returns.
In either case, a bear or bull.
Exactly. But without a lot anywhere near the volatility that
Okay.
Index investing creates. So
So if
that's kind of the
yeah, it could be a hedge instead of people buying puts or VIX that erode in value.
That's right. That's
As
right.
time passes, that these could be hedges for if we ever have a bear market after this melt up.
Will we ever have a bear market? That's the question, Dale.
Yeah.
Will it ever come?
I think I'll fade the market when China comes in and buys our stocks. Or well,
There you
maybe
go.
we should wait for the Fed, but that would happen after a long bear market. Bob, I always enjoy talking to you. It's fun and compelling. And uh, what do you think the number one thing people should keep in mind about the markets over the next 30 days?
Oh, the next 30 days. I mean, I think probably the biggest thing is that
Yields?
the the data, the Fed is going to follow the data, and the data is pretty good. And so we could easily see, if that data continues, which I expect it will, we could easily see the aggregate pricing of weak U.S. conditions really come out of the market, and that could create, a significant move, particularly in the bond and short rate market.
Yeah.
Would be my thought.
Okay. So, we have this big move that is 440 viable on the 10-year.
For sure. I mean, if you think about just like a simple valuation calc on 10-year bonds, if you just take, let's say you take 2% real rates, 2.25% inflation, and 75 basis points of term premium, like you've got, 5% yields right there.
Yeah.
So
Okay.
um,
That's back to the
that's
old highs.
is that possible? Sure. Those numbers are totally plausible in the context of the economic conditions that we're seeing here. And remember, I mean, you remember, of course, like bond yields of 5% are not, we're not that unusual through, most of the course of
Yeah.
even both of our lifetimes.
Yeah. Yes, all the way back to the dinosaur. And you know what,
That's
Bob?
right.
I just wanted, for me, Bob, not you. So I was wondering if you had a bottle of champagne there in the office with you.
I don't.
All right, because we're live and we're only about 10 handles away from S&P 5,000.
That's
So
pretty amazing, right?
yeah, yeah. So I thought that maybe we'd uh,
Open a
hear
bottle
a
of champagne
yeah,
for
hear a cork. Happy days are here again, Bob.
That's right. That's right. Every advisor in the country is popping the champagne bottles once that goes through 5,000,
I
right?
always wanted to know what it was like to be alive in 1929. 28, 29. Anyway, Bob, great talking to you a few times this week. People follow Bob. He has a YouTube channel. You could follow him on X at Bob E Unlimited. And that's because as market conditions change and evolve, he has unlimited perspectives to give to you. So that's a wrap. And thank you very much, my trading warrior brother.
Thanks so much for having me,
Enjoy.
Dale. It's always a great time.
All right. Bob Elliot, everyone. Thank you, Bob.
See you
Talk to you
later.
soon.